So the first two videos covered what private credit is and what is happening in the market right now. This video is about the practical question, what does this mean for your portfolio? Because the honest answer is that it depends significantly on where you are in your relationship with this asset class. Whether you have no current allocation, an existing allocation, or actively evaluating adding exposure. Hi, my name is Paul Carroll. I'm the CEO and founder of Avion Wealth, and let's address each of those situations directly. Before addressing these three scenarios, it's worth naming something that tends to be underemphasized in the marketing around retail private credit products. By the time an asset class becomes accessible to individual investors through packaged products, the best opportunities in that market cycle have typically already been captured. Let's face it, the retail investor often gets the detritus at the bottom of the barrel. Institutional investors, be they pension funds, endowments, sovereign wealth funds, they built their private credit allocations over the past decade when the asset class was younger, less competitive, and more generously priced. But today's retail products are being launched into a market that is maturing, crowded, and already showing early signs of stress. There are several structural considerations that retail investors in these products now face. Let's talk about deal quality. Institutional allocators typically access the strongest opportunities first. Retail vehicles, the ones that you're being sold, they receive residual, what we call lower tier exposure. Let's talk about fee drag. The management fees of 1 or 2% annually plus performance fees compress the net returns meaningfully over time. Liquidity mismatch. The underlying loans are illiquid. You can't just call them. Quarterly redemption windows can be gated precisely when investors most want to use the funds, and as we've seen in real time with the Cliffwater and Morgan Stanley situations, you can't always get the money when you need it. And finally, timing risk. Retail access to this asset class arrived late in the cycle, at peak valuations with rising defaults. So none of this means that private credit isn't suitable for all investors. But it does mean that decision deserves considerably more scrutiny than just the yield alone. If you have no existing private credit exposure, there's really no urgency to establish any in this environment. The stress signals emerging in early 2026, be they redemption pressure, rising defaults, and tightening bank credit, suggest the next 12 to 18 months may offer more attractive entry points as weaker funds are forced to reprice. In this asset class, patience may be a genuine competitive advantage. Now, if you're already allocated to private credit, the most productive thing you can do right now is examine the mechanics of what you already own. Understand the redemption structure. Know whether your fund uses payment-in-kind interest structures. Ask what percentage of portfolio companies are showing covenant stress or requesting amendments. Ask how your manager values assets and how frequently that valuation is being reviewed. If your manager cannot or will not answer these questions clearly, that is meaningful information. Transparency in how a fund is managed during periods of stress is one of the most reliable indicators of how it will perform through a full credit cycle. Now, if maintaining or establishing exposure is consistent with your broader strategy, a few considerations may be worth reviewing. Manager selection matters considerably more in private credit than in most asset classes. And that's because there's no public market to provide pricing discipline or transparency. There's no good index fund for this type of product. Prioritizing managers with long track records across multiple credit cycles, transparent reporting, and a genuine alignment of interest with investors may help mitigate some of the structural risks we have discussed. Position sizing also deserves attention. Now, private credit may serve as a complement to a diversified portfolio, but sizing it as a core income replacement, particularly in the current environment, may introduce a liquidity and credit risk that is difficult to quantify from the outside, and it's likely more risk than you want in your fixed income portfolio. And that yield figure, that deserves to be stress tested. Reported returns of 8 to 9%, they carry an embedded illiquidity premium, and in the current environment, rising default exposure. Whether that yield adequately compensates for those risks, depends on your full financial picture and not just the yield itself. We have already noted that private credit has a legitimate role in the financial ecosystem. For the right investor, in the right structure, with the right manager, it may represent a meaningful addition to a diversified portfolio. But at the current moment, rising defaults, liquidity stress, and a cohort of retail products launched late in the cycle calls for a clear-eyed evaluation rather than yield chasing. At Avion Wealth, we work with business owners and high net worth investors to evaluate exactly this kind of decision in the context of a complete and coordinated wealth strategy. If a private credit allocation is something you are actively considering or already hold and want to review, we offer a complimentary second opinion service focused on how alternative allocations fit within your broader wealth confidence plan.